People often are preoccupied by governments defaulting. Instead, the private sector debt is what is really makes an economy very fragile. If an economy is highly leveraged in its households and its corporates, that's a problem, Alexei, because if I have $1 of income and I make $3 of that, $4 of that, or $5 of that, the moment interest rates go higher and I need to allocate more of that dollar to service my debt, I cannot print new dollars as a household or as a corporate. I literally need more earnings, more salaries, more cash flows if I want to maintain a healthy proportion of spending. Most likely, I cannot do that. It means my salary remains stable. My cash flows as a company are more or less predictable. If interest rates go up on my large pile of private sector debt, I will be forced to allocate more of my dollar to debt servicing rather than to hiring people, spending money. And that means the economy goes in a recession pretty quickly and things become unstable when the private sector is more preoccupied on servicing their own debt rather than spending money in the economy. Every crisis you have seen over the last 20 to 25 years or 30 years even hasn't really been driven by high levels of government debt, but I can walk you through the Japanese crisis of the 90s. What happened there? Was it government debt? No, it was the real estate bubble. Japanese households had become leveraged 250% private debt to GDP. And as the Bank of Japan was trying to cool off the real estate bubble, raising interest rates just at the moment when the Imperial Palace of Tokyo was valued more than the entire state of California, this is the level we reached. When they raised the interest rates, the whole thing became unsustainable for the Japanese private sector and the bubble burst. You can go to the Asian tiger crisis of the 90s, Thailand, Malaysia, etc. Same story, private debt, 200% of GDP. Spain joined Europe when the Maastricht Treaty were made, and they told Spain, you can't make a deficit higher than 3% of GDP on a government perspective. And so Spain said, you know what, instead of levering up my government balance sheet, I will lever up my private balance sheet. And they made credit ample and cheap for households. The Spanish real estate market also went in a bubble. What happened in 2012, 2013? Eurozone debt crisis. The US in 2007, same story. So private sector debt is the real vulnerability rather than government. It's more complicated for governments to default, let's say, or the conditions to be in place for governments to default. Instead, have a look at the private sector. It's much more vulnerable.
And now if we just take that and we look at, for example, the state of the percentage of private debt to GDP worldwide, which are, let's say, the 5 countries or regions where you're the most concerned at the moment?
So this is a good question because now I'm going to raise some eyebrows in our audience. And I'm going to say, think with me of all countries you can imagine in the world that are rated AAA. So they are supposed to be the safest. And I will tell them there is a high chance each and every one of them has a very high level of private sector debt. So Australia, check. Private sector debt is, I think, 200% of GDP over there. China, very high private sector debt as well, although the government really isn't indebted, the private sector is very leveraged. Switzerland, private sector debt to GDP, 240%. The Netherlands, private sector debt to GDP, over 200%. Sweden, private sector debt, over 200%. Canada, private sector debt, over 200% of GDP. All these countries, all of them are rated AAA because their government debt to GDP is very low. So on the government side, they aren't doing fiscal deficits. They're being very conservative. They are not injecting money in the private sector. They have high tax rates and so on and so forth. And so what? The private sector is saying, well, if you government are not loose enough in your fiscal policy with us, the private sector, so you don't cut our taxes, you don't inject investments into the economy, well, we will need to lever up ourselves. And so the private sector in these countries is very indebted. Generally speaking, that tends to work until as long as interest rates are lower and lower and lower. So think of certain European countries, for example. Europe is a good example of that, right? So as long as interest rates in Europe were negative and mortgage rates were below 2% and corporate borrowing rates were at 2%, the private sector could lever up French corporates, extremely levered up. The Dutch private sector, very levered up. But then what happens is at some point, these interest rates go up. And as interest rates go up, slowly but surely, a bigger and bigger proportion of the households and the corporates will face a problem. The problem is, hey, my old mortgage, my old corporate loan is maturing. I need to roll it. They go and check the borrowing rates, and it's not 2% anymore, it's 5 or 6. Has their salary gone up or their cash flows gone up by 30 or 40% to offset that? Probably not, Alexei. So they will face a situation where they have a similar pie of income to allocate, but all of a sudden they realize their debt costs way more than they thought it would cost forever. And so when they go and refinance, and the larger share of the private sector goes through this refinancing process, it's bad news. And the only thing you can do is cut spending, try to shed labor. So countries that have raised interest rates really aggressively following the Federal Reserve, and that's Canada, Europe, the UK, Sweden, New Zealand, all these countries that have fragilities from the private sector perspective, they now face a problem, and we are seeing it happen under our very eyes. The Eurozone is effectively stagnating for a year. Real GDP growth is 0 at best, and in some countries you're already falling into a recession as we speak. UK, 0 real growth, with the recession looming there as well. New Zealand, pretty much in a recession. Canada, third quarter GDP negative, so they're going there. Sweden, already pretty much in a recession. So what I'm saying is all central banks have tried to raise interest rates to fight inflation. That's been also reflected in bond markets. Bond markets have therefore made borrowing more expensive for the private sector. Mortgage rates are higher, corporate borrowing rates are higher, but not every country is in a position to sustain these higher interest rates. And not because of the headlines you often read, the US is going broke, blah, blah, blah. It's not a government problem first, at least at first. It's a private sector problem. That's where you should pay the most attention to.
That's a good point, I think, because a lot of people, especially in the past months, when we talk about also like the interest rate payment from the US government and so on, the fact that they've been also downgraded for the debt and so on and so forth, is kind of like, especially if we look at the grander scheme of things, the dollar or the US will always be the least hurt in this kind of setup anyways.
That is so true, Alexei. In a system where we have leveraged the entire world around the dollar, and this is called the Eurodollar system. So the Eurodollar system is effectively a system where even if you are not a dollar entity, so you do not reside physically in the United States, you can lever up and you can borrow in dollars. Fantastic. So if we are gonna pay all our commodities in dollars, all our foreign invoices is gonna be done in dollars, all our services abroad are gonna be sold in dollars, it's great. I can lever up my balance sheet as a corporate. I can have more debt in dollars. I can finance more spending in dollars. Everything works amazing as long as dollars are freely flowing around the world, right? So I am a Brazilian corporate. I sell soybeans, okay, in dollars to other companies around the world and other countries. And I can lever up and I can borrow in dollars, even though, remember, I can't print dollars. My central bank cannot print dollars. I'm in Brazil, not in the United States. But I can lever up and borrow dollars, and everything is fine as long as I'm selling soybeans. So more dollars are coming through my door, and I can use them to service my dollar debt. We have levered up a system around the dollar. There are 12 trillion, not billion, trillion dollars of debt issued by companies and entities that are not in the United States. So the moment that you make this dollar flows tighter, maybe because the economy is slowing down, so you are not really selling so many soybeans anymore, or maybe the Federal Reserve is making dollar borrowing very expensive by raising interest rates, it's not the United States that gets hit the most. They also do get hit, their private sector mostly gets a hit, but think about everybody else in the world. These guys don't even have access directly to the dollar. And now their dollar borrowing is getting more expensive at a time where the economy is slowing. So the organic flow of dollars is also slowing. And so you deflate a system that has been leveraged and inflated around the role of the dollar that hurts more foreign countries than it hurts the US itself. And this is a concept that people have a little bit of a hard time to understand, but it is important because to destroy or to change and modify the paradigm of this dollar system, you need to break it from within, and break this system from within, funnily enough, will hurt more outside countries at first than it will hurt the United States itself.
Thanks for watching. If you liked this episode, give it a like, and don't forget to subscribe. Leave your actions down below in the comment section. And if you want to watch more videos, feel free to check the most recent video, but also any other video that we've had published on the channel before. See you next time.